Morning traders, welcome to the Traders Lab. I'm your host, Tom B. Appreciate you stopping by. Could I please get a screen and audio check in YouTube and the Bookmap Discord community? Oh, well, thanks, Marty, and good morning. And Plato, thank you so much for the check in YouTube. Well, thanks everybody for visiting Trader Lab today. The stream's about integrating Bookmap order flow tools, using the volume profile as a chassis to overlay structured trades on. It's based on the idea that trading is a business and it is based on statistical probabilities and structure. While the market itself is 100% random 100% of the time, and I'm not saying you have to accept that. However, if you consider how casinos or gaming operates, we only, or even the casinos, only have control over the game they play. Once the cards leave the deck, the cards are random. How gamblers play the cards are random. So the only control the casino has is to exercise the game they have that has a statistical edge that favors them, even though the outcome of the specific interaction is 50-50. In other words, it's random. However, the edge shows up over a random distribution of interactions or samples. So the business of trading is really built on top of a proven business model in an environment where there's no control beyond what you control. And that includes controlling yourself. That's the business of trading. The idea of Trader Lab is to help traders understand the business they're trying to be in and potentially create sustainability in this environment. And this environment will challenge you beyond anything you've ever done, because we are wired to avoid uncertainty, yet we are in a business of 100% uncertainty 100% of the time. And while it may seem like, well, I'll do that, I can do that, you're going to find that I believe anyone can learn how to trade in Trader Lab. However, being able to execute in the environment of uncertainty, which triggers fear, FOMO, and the rest of it, those are the things, in my opinion, if you do the work, that'll still be a substantial obstacle to performance. And we have tools to work with that, but in the end, it's going to come down to you. General disclosure, all Bookmap Ltd materials and presentations are for educational purposes only and should not be considered specific investment advice or recommendations. Risk disclosure, trading futures, equities, and digital currencies involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Please remember, this is not a trade calling room. This is based on structured trades that you can learn and are available to everyone in the Bookmap Discord Trader Lab community, as well as a library of webinars, a document section, and the community itself. Trader Lab's made up of a group of like-minded traders who've come together to leverage their collective experience. It doesn't matter how long you've been trading, what you've been doing. None of that matters. What does matter is that you have a desire to create sustainability. In other words, business. The other thing about this is that we all have random winning trades. That's one of the things that keeps us doing what we're doing, even though we're continually leaking equity. Everybody has winners, and if you stop and think about it, it doesn't matter if you had a random buy-sell generator, you still have winning trades. So that is what typically keeps us on a track of trying to make it better, try to fix it. And of course, it's logical. However, most of those random winners have no edge. So even though you have random winners, same as the gamblers, over time, the house is extracting the dollars from the gamblers, and you may be sitting with the gamblers in spite of your intent to sit on the house side of the table. Do you know how to do that? And most retail developing traders never get to the point of being able to understand the business they're in because they're too busy chasing, adjusting, curve fitting, multiple time frames, multiple indicators, and the rest of it. Because of those random winners. I created a term for myself for that, and it was called Trader Groundhog Day. Working hard, waking up in the same place. This is the process that I share in Trader Lab. It's what's worked for me over many years. I started in 1980, and I will tell you too many years went under the belt, you might say, or over the dam, where I kept having winning trades and still was leaking equity. And that doesn't mean I wouldn't have runs and successful weeks and months and thought that, gee, I got it now, and then trader Groundhog Day. I found, how does the market work? It's not our indicators. It's basically a discovery process of valuation. What is this thing worth? And the same thing happens in your supermarket, but the time frame doesn't change, really. You have a sale price, you throw 4 in the cart. There's a fair price or retail, that's high volume, right? Buyers and sellers say, okay, let's do business. You buy it, they sell it, everybody's happy. But if they raise the price and it gets too high, you're not going to pay it. You'll either find an alternative product or you'll do without it. So this is what creates our rotations, this idea that what's retail, what's too high, what's too low, and this creates your rotations. Now, the way we observe this is the volume profile, because we see price and volume. Most of us, when we're growing up in trading, see vertical volume based on time. It's not the volume and the time in a time frame. It is the price and volume. So that's a horizontal representation, not a vertical one. Time frame is, well, what do you operate in? We can be in a bull market and the market's going up, and we can be short, just like today. Well, how do you deal with that? Isn't it conflicted? Well, yes and no. It's a vertical integration of time frames. Now, you try to do the same thing with your multiple time frames. However, let's think of it a little differently. Let's think of it as Matryoshka dolls. Nesting dolls. They're, the Russian dolls. They're inside each other. So you can have a time frame going up, you can have another one going down, and inside of that, there's more quote time frames. Now, when we get inside with order flow of the developing time frame, there's no time. It is, what does it take for buyers and sellers to interact, and then can we detect change? How quickly can we detect change? And if we can organize it within a structure of multiple time frames in a vertical integration, and don't let that bother, you're already doing it, but you may not be doing it in a way that actually helps you. And of course, everything's random. Now, this is the catch-22 right here. Context. What is the context? What is this context? Context is, what's the condition of the market? Bull market going up, and this morning selling market. Oh, how do you do that? Well, context is a developing condition of the market. And as day traders, what that means is, once we get a sense based on a context sheet that I've shared, it's kind of a flow chart, and I'll discuss it with you in a moment, that gives us the sense of the lay of the land, and then there's certain trades that are qualified in that configuration, in that context. When the context changes, and it does in different time frames, and this will get you crazy, then the trades that were qualified in the previous one are no longer qualified, and you have to change. So, and unfortunately for all of us in day trading, that we only have the benefit of hindsight when things change. However, having an order flow tool can kind of give us an edge on detecting the potential for change. And I'm going to show you that as I show you every day here in the stream. And like everything, we all take stops. We all have losing days. We all get frustrated. We are emotional beings. But how can you figure this out? There's 60 PDFs of structured trades you can download, and they're available in the Trader Lab, as well as a library of webinars. Some of these streams up to 4.5 hours long of real-time narration. You can download these, and I'm going to disappoint all of you right now. There's no plug and play. You actually have to understand how the market works, why it does what it does, and how to get in alignment with it. That's the work, and it's not your indicators doing the heavy lifting. If it was, we'd all have indicators. Now, I want to show you something. This is called a volume profile. And before you jump out the window, which might be an idea, hold on a second. Okay. Now, what you're seeing here, this is volume. Remember I said volume at price. So you see, as an example, up here, yesterday's high, the volume, this is it here, the volume tapered off. That was too high. The fair price from yesterday was this orange line. This is where the highest volume was. This is where the buyers and sellers said, you know what, this is the fair price. Okay. Now, from a previous day, this orange line was a retail price. It's off the screen, and it was too high. What the market tends to do is come back and check shopping. I'm not paying that, and it could go down. Well, it works on the other way, too. it's too low, it might go up. And now we have another price from the ETH, and I'll show you all this in Bookmap. It's called the overnight volume point of control. So we have RTH and the term volume point of control, just think retail. In other words, the last auction, and these for the RTH, these were where the highest volumes were. So that was the highest volume of everything that happened yesterday. This is the highest volume from a previous day, last time we were up here. And this was the last auction, the overnight volume point of control. Volume point of control, overnight volume point of control. ETH is its own auction. What's too high? What's too low? What's the retail price? So they were willing to buy and sell S&Ps here. Okay. So what do we know? Well, that's fair. This is fair from previous time we were here. This is fair from yesterday. And now we have a couple other things. Now, this is yesterday. We have a single, and thanks, Willers, for pointing this out. Kind of missed it. A single is where it's like an internal gap. Market profile is made up of something called TPOs, and before we had volume, we used time. We didn't have volume, it didn't exist. When I learned market profile in the mid-'80s, I think it was 86 or somewhere in there, from Peter Stottlemeyer, he created it. This was called a single, and they're basically an internal gap, 30-minute TPOs, so like 30-minute bars, if you will. Okay, and the next one was down here at the first hour's high, called the IB. So when we're coming down today, we had a couple of targets, 58. Now the next one was 55. 54, 55, which I posted. Doesn't mean anything other than it can do whatever. Next one is here, and then further down was another one. So, and nobody knows, okay? Now, this is important. Now, here's another element that I want to tell you about. Most don't talk about this. You see this skinny area here? This is a low volume zone. What created it was once we came out the first hour's high, and if you remember yesterday, if you followed the stream or if you review yesterday's stream, this was a long. And we got long in Trader Lab, and the goal was to actually go there. But we got pretty close. That's life in the fast lane. So, but this low volume zone is not auction. What happens is the market is an auction, remember. So what it does is it goes back and forth and does its thing. Like this is an auction. Too low, too high, singles, retail. If this price is too low, we can leave it and accelerate. And then we come up here and we do the same thing. Too high, too low, retail. This is for the day. It is a higher time frame. In a more shorter time frame, the same thing happened here. You see this little thing here, this rotation? It's the same as this, except this is much bigger, more volume. Same concept, fair price. But what about this? Why did we leave this one? Because it was too low. So the nature of the market is to check what's too high and then what's too low. Well, is that too low? No. What about this one? No. Well, if I get under here, then what? Here, then what? Is this still too low? Is it there? No, it's there. That's the current low of the day. Doesn't mean we won't take it out. It just means, isn't that interesting? This is how the auction works. There are no indicators here. Now, you're going to say, well, it could have done anything. Guess what? Whether it's your indicator, this, or a dartboard, it could do anything. This is how the auction works. Now, is everybody with me? By the way, if you have questions, please post them. I'll do my best. Now we're going to get in the Bookmap and see how this all works. How we do it in YouTube? Everybody conscious? Is everybody with me? How we doing in the Trader Lab today? If you have a question, throw them in there. I'll do my best. If not, I'll answer them later. If you're in YouTube, post away. And remember, if you're interested in Trader Lab, you can get your answers there and maybe find out what you are doing that might not be getting you where you're trying to go. The only reason I can make that statement is that's what I did. And I did it much longer than you. I've been doing this going on 47 years now. So we've all walked in the same shoes, some of us longer than others. When I started out, technical analysis with all these canned indicators was new. We didn't have PCs, we didn't have an internet. So I would say it was a bit different. So I went down the yellow brick road of extracting and seeing indicators and then thinking those were the magic mix would be the holy grail. There's the answer. I'll find what nobody else has found. Well, early on, that might have been true because nobody else was doing it. There were no off-floor traders when I started. All my friends were floor traders. So I was kind of in a unique situation. Unfortunately for me, and it's only in hindsight, I found out and I spent too much time working with these indicators as they were developed and also creating hybrids. So I spent many years working with mathematically based extraction or derivative indicators, which ultimately didn't work, but they all work randomly. So you spend a lot of time thinking it's just tuning, tweaking, and the rest of it, right? Well, that wasn't the answer. It was actually the problem. But it took me a long time to figure it out. I figured at one point the best I would do is I'd develop a system and I'd optimized all these variable random elements. And I believed that was the solution. So I did optimizations. And in the end, even though I did what's called, I take chunks of data and do walk forward testing and have good numbers, I was always optimizing or curve fitting on the past, not responding to the present. Now, this was back when I was doing trend following. And for me, a short-term trade in the large S&P was a 2 to 3 day swing. Before day trading, we didn't have the technology. But just give me a sense. I did that, and then I tried to apply system design to shorter time frames, and it didn't make any difference. So anyway, so much for that. This is the RTH Open. There it is. Now, this is the overnight volume point of control. So what are we doing? We are yesterday's settlement. Let me find where that is. Let me just get myself oriented here. ETH high is here. Got to just get myself straightened out here. Yesterday's high is here. Where's yesterday's settlement, guys? I kind of lost it here. Can someone tell me where yesterday's settlement is? Uh, 71.5. So this is settlement down here. Okay. All right. So we opened higher inside of yesterday's range, correct? Let me make sure I got this right here, guys. This yesterday's high, right? Yeah. Okay. Thanks. Wait a minute. I'm sorry about this. I just, things are covered up over here. I just want to make sure. Okay, yesterday's high is here. So this is opening out of range, higher outside of yesterday's range. So it's a gap. What does it mean? The market is out of balance. Now, when we open higher, if the market's out of balance, there's two possibilities. We can open higher, we can go, or since the market's long from yesterday, this is something that's really important to think about. The market, now this is, I know, don't fall out of your chair, just put your seatbelt on. The market goes up to go down, and the market goes down to go up. Why is that? If we had a run yesterday and the market's up and we get a gap, what we're going to get is potentially continuation buyers. But what about the longs that are in the market from yesterday, right? Market goes up, open higher. Now, let's assume you're long. Let's put yourself in the other shoes of the other traders. You're long, you're hanging out, and you're thinking, oh, I got it made now. The government's going to open up. They're going to sign this, the agreement. Happy days are here again, new all-time high, whatever. Well, what about the longs that are already in the market? What does the market do? The market goes up to go down and goes down to go up. So why does it do this behavior? Now, it doesn't have to do anything, but the reason it might do it is because the longs in here from yesterday who now have a gap, if they see the selling, they're going to start taking profits. They're going to respond. That's called responsive selling. Now, if we get responders, then the longs that are in here from not only the gap or anybody who bought the gap, the breakout traders, God bless them, we need them. The breakout traders put their stops under the opening swing low, or they become the sellers. Lovely. Now, if we fill the gap, then we have the longs from yesterday who are also running trailing stops. So you see, we have built-in sellers. And this happens in all rotations, just so you know. There's always a seller and a buyer. But if you get a down rotation, aren't there buy stops above it? Along the way, not just at the top of the swing, but all the way down by retail traders who are risk adverse. Once again, we're all risk adverse, but it creates the selling process. So in our situation, if we gap and we're above yesterday's high, stops are up here, buy stops, and then if we gap, we can have sell stops. So here's our RTH open. Now, we go to our context grid sheet. Now, this seems like a lot of work. I know. So what does it mean? We're opening out of balance. Either we're going north or south. Brilliant. Is the market responsive? Yes. What does it mean? We fade the gap back into yesterday's range or into balance. What do we watch for? The test of the previous range here and value area. Value areas where 70% of the volume took place yesterday. If we get in here, then we can start working down. And if we get into the range, what does it tell us? If we get inside yesterday's range, we can still work the shorts. We can watch for a rejection and a retest of the previous close or settlement and the value area. And then does the value area hold? If we get inside here, then the market is rejecting what's up top. There's a high probability of trading through this value area, about an 80% probability if it's narrow. And what did I show you? I got to find it again. This is how you put pieces together. This is narrow. So the idea was if we find too high, wherever it is, and we get our selling, we can come back in here. And then these are targets here, there, and further down if we keep going, which, part of the thrill of randomness. So now this is all before the market opens, okay? Now, we don't know what's going to happen. So now we're going to go into the, I don't know. Tom, don't you know? No, I don't know. How do you know you don't know? Because it's random. Oh, so you're not predicting. No, I'm not. What are you doing? Trying to align. How did we open? Higher outside of yesterday's range. Here's some statistics. You can download these. Again, why am I going through this? This is what we do in Trader Lab. We want to create edge. We're not playing a video game. We want to stack, quote, the odds. What are the odds? Probabilities in our favor. And we're still going to take stops. We're still going to have losing days. But do you think if you have a trade plan and you prepare and you know the possibilities, and when you recognize them, you can align as quickly as possible based on your plan if it fits, and then know which trades at what locations might give you an edge, even though you're going to take stops in spite of it all, right? Oh, you don't want to take stops? You can't be in business and not pay bills. In the casinos, they pay to gamblers. What is it called? Overhead and cost of production. We are risk averse. We are fearful, and we're wired for that. So we have to learn how to manage our emotional states to be able to operate in a random environment. That, my friends, I believe anyone who comes to Trader Lab who does the work can learn how to trade. Whether or not you can manage your emotional state and FOMO and fear and hesitation and looking for confirmation. Is the word certainty and confirmation in your vocabulary? When it comes to trading, it doesn't exist. So instead of seeking it, you have to learn how to operate where it doesn't exist. And you don't have to accept my word for it, of course, but your results are the ultimate truth. So this is the RTH open. What is it going to do? I don't know. By the way, there's our overnight volume point of control. I'm going to give you some statistics. We're opening higher out of range. So write these down. You have to vet these. There's an 81% probability the market goes there. Oh, that's nice. Okay. Taking out the ETH high or low has about almost a 98% probability. Taking out the first hour's high or low, called the IB, has a 98% probability. Getting to the overnight mid has a 68% probability. Getting to the naked of volume point of control, a 38% probability. You notice it's going down. Filling the gap, getting to yesterday's high, a 67% probability. Actually, this is yesterday's naked volume point of control, about a 38% probability. Okay, let's see what else. And a 20% probability to get to the value area low, and the value area high, which is interesting and important for us. I got to find it. About a 55% probability. So this has good probability, and getting here about a 30-ish% probability. But what determines the statistics is the condition of the market. So we can have a low probability going in one direction, but what number one is the context. Remember the driver, context and alignment. So statistics can go out the window because a statistic is over a large sample size. It is not specifically aligned with the condition. So these are some of the things you got to deal with. So we open here. Let's look at the first trade. So for me, I was looking for responsive selling. And it doesn't mean, anything. What I look for just means if I see it, I'm ready for it. If I see something different, I'm going to go, oh, that's interesting, and I don't have a trade. I got to, now I know the condition is different. The RTH open is a very high risk place to trade. You don't have anything to lean on. You have to have unconscious competence. This is not where anybody should start, but this is where you can learn market mechanics. The reason this is problematic is speed and no structure. So you're kind of like dancing with a blindfold on next to the edge of the Grand Canyon. So this is the initial high volume. Let me explain what you're seeing. Remember the auction, too high, too low. High volume is retail. It's right there. This has over an 80% probability. This was the retail price from the ETH. So I know the market can go there. It can go in whatever it's going to do. I'm looking for selling. And I have my liquidity here. So this is the Bookmap. It's showing me the liquidity in the limit order book. So I see nada down here. In other words, it's dark. And I see the liquidity here. So these are sellers, all right? And you see them over here. So basically, what's over here in the limit order book, we see in something called the heat map. Now, back to the profile. This is our retail price. It starts at 0. Right here is a micro high volume structure. Let's talk about shopping. I think of this as a store. It's the easiest way. This is shopping. It's a supermarket. What's too high? What's too low? What's fair? This is your mini mart because it's a mini structure. Too high, too low, retail. If this price is too high and I leave it, this is like getting in the car. I leave the store. I'm not paying that. That's too high. And now I consolidate. Now there's more volume here than there was there. What this says in microstructures, this is too high, maybe. Now remember, too high might only be too high until we find too low, you see, part of the thrill. So VWAP in mid, liquidity pressing, too high, too low, too high, too low. Retail. So what's this over here? Too high. I'm going to label it. Now, for me, and this is not a recommendation, you got to vet everything. This is resistance. Shopping. Let's go back to the store. I'm not paying that. You ever say that and you walk out? I'm not paying that. Now, this is the new retail price. And what happens here, the way this works is we've got sellers here and buyers here. You're going to go, that's brilliant. But why is the market not going up? Because I got my passive sellers here, and the only reason the market goes down is because there are sellers absorbing the buyers. See the delta? There's buyers here, market orders. Well, if I've got aggressors, and aggressors can be stops and icebergs and market orders, actually. Icebergs are limit orders, I'm sorry. So aggressors are market orders and buy stops, which become market orders. So I got buyers. Why aren't we going up? Because there's passive. So I make a new low here. I rotate down. So that is saying out here might be too high. This is the retail price. And I got buyers absorbing the sellers. You see the delta. Why isn't the market's going down? Okay. And now I have a buyer who absorbs. Those are aggressors. So let's watch the behavior. What is this? If you're in Trader Lab, here I have my buyers. Why aren't we going up? Notice the heat map. Now I'm in micro, minutia, your eyeballs might be spinning. What do I know? I'm not paying that. What do I know here? Too high. This is a short in the Trader Lab. Very aggressive, and this is only for experienced traders. Now let's watch the behavior. VPOC migration. Too high. I'm not paying that. You're such an astute shopper. Oh. Well, what is this trading thing? Isn't it shopping? Isn't it? What is this thing worth? Now, I don't know. Now, the other thing that's going to happen here is, let's talk about the market goes up to go down and go down and go up. If the market goes down and I have sellers now, where's my stops going to be? Up here, right? Let's call this the opening swing high. So this is the open right here. We'll see you later. Sellers are right here. So this is my opening swing. It's very important. What's at the opening swing? Stops. So do we want to forget about that? No. One moment. So there's a possibility we're going to come back here and abuse these guys. Why? Buyers are in this leg, buy stops. Now, this is my fair price, my high volume. What happens if I drop, if the volume comes here? What does it say? Let's talk the language of the market. I'm not using indicators. This is a language. All we're doing is we're shoppers. Traders are shoppers. This is the new retail price. What's above me? Too high. So what does it say? Until it changes, I'm seeing responsive selling. Okay. I know the market's long from yesterday. Remember the top of the stream. There's sell stops in here. And if you're hanging out long, your teeth are chattering and you're going, uh-oh. New retail price. New retail price. I'm not paying that. Get out of here. Sweep. Right here. Sweep. Here's the possibilities. Counter rotation. This puts me on guard that I might get a rotation right here. What else? Overnight mid. What was that statistic? I know you write these down, but you probably forgot. 68% to go there. So how do I trade this thing? Now, again, what I do, you do, not material. But let me tell you what you might do. What you might do is understand that the market, with this pressing liquidity, is going lower on responsive selling. You would understand that the price, which is built off consolidations, buyers here, sellers there, and this is the developing volume point of control is what it's called. It's your fair price. When it becomes unfair, I'm not paying that. We leave it, and then we do our thing. And if we leave it, we do our thing, and we leave it. Now, statistically, here, where's my scale? Subject to my plan, it could be there. Ahead of there. I always leave some for the sweeper. Now we have a naked volume point of control that was left open, and it was a target coming up yesterday. We missed it by a little bit because yesterday's high was right here. This was our target yesterday. Hey, life in the fast lane. We didn't get there. But when we come from the other side, we have to be conscious that this might now be too low. And if it is, I can come across the range and come back here or go wherever. So you have to be aware of these things. We don't know. Do you know? I don't know. Watch. The target then, the next one is yesterday's high. And you'll notice we have liquidity resting in the book. So for me, I was looking to fill the gap. And now let's watch. Now remember, target is there, target is here, and then target is there. And all of this is like, I don't know. So what do we have? Let's come back to the store. Too high. Now the reason I'm labeling these is because they're auctions or consolidations. And an auction is a consolidation. So if you know what a consolidation is, you know what an auction is. Because the market pauses and it's sellers, buyers. And if we leave it, it's going, and right here, it's saying too high. I'm not paying that. Listen to the language. Break down. New retail price. Too high? What about this? I'm not paying that. Get out of here. Come back. What about this? Too high. Now, what about this? New retail price. Do you notice a change? Right here, I come over this retail price. For this to continue lower, I have to, this is like resistance. I have to reject it, get below here for the opportunity to fill the gap. Let's look. See the change. Now, I don't know what's going to change. Do you? Nah, I don't know. But here's what I know. I know the market is short, and I know I have a gap, and I am somewhat comfortable based on my statistics that there's going to be stops if we get into yesterday's range. So I know there's going to be stops in here if I can get in here. And let me ask you a question. Are these new buyers, or is it the buyers that are in this leg? Remember, the market goes down to go up. Now, and what else do we remember? That up here, wherever it was, the opening swing high is over here. There's stops. So that means there's buy stops at the top of the swing and all the way down. You have to remember that. And there's an 81% probability to go there. So let's watch. So now I get my buyers. Now, subject to your plan, you have to have trade management. And that's something that is time frame specific. This, depending how you want to do this, either you're going to hang out and your stop is way outside somewhere, or you're going to be managing behind some structure. Too high, going to zero. Absorption is here. Why didn't the delta go down? Watch what's going on. Sellers, lower price, less delta, which means they're still sellers, but they're weaker. Lower price, less delta. This is delta divergence. You've heard of that, right? Now, nobody knows till hindsight. I mean, we could have just as well had, this come up here and it could have get slammed. Didn't. So here's our buyers. Notice the delta. Aggressive buyers. So I have my sellers, less sellers, delta divergence, strong buyers, and this is when your teeth chatter. It's like, what's going on? Resistance is here, and I get my sellers here. This is very important right here. Sellers, divergence, aggressive buying, support. Don't know. Buyers, there's my absorption. They're being absorbed, but the buyers, look at the delta. Even though I've got iceberg selling, the buyers are still more aggressive. Now, here's my seller. This is the, as we say, the last hurrah, and they get stuffed. Also, well, look at the location. This was our target yesterday. The market, and there's the high, and we were going for this. The opposite. We come check from the other side. Isn't that interesting? Too low. Now what? Now, if this is too high, I can come down. If now this is too low and going up in time frame, this is too low, I can come across. Say, watch. Now, I get taken out of these things too, so I'm short and I'm trailing and I'm going for the gap fill, and I get thrown under the bus with everybody else. Hope you don't think that somehow I can avoid that. So what do we do here? We pick the opening swing high. Why? Buyers are in the down leg, and now we have sell stops, sellers in the up leg. So now this is my 81% probability, and I'm looking towards this. And then, it's kind of like, what's happening? But let's look at what's happening. Variable high volume node, RTH open was over here. Variable high volume node. We pop. So I'm looking now for this, and that's my test. I'm looking for it to come up here, and then if it does, and I also am aware opening swing highs, buy stops. So here's the buyers coming out. 65, 12, watch. And I don't know, I sit here with my jaw on the desk just like you do, so it's not a big deal. Here's what I see. Now, I am looking higher. I'm going to show you something interesting. Hold on. Got to move this down for you. Now, some of the tools, this is the stop and iceberg detector. Now, and here's resting liquidity. Now, so you understand, I have no idea. I know what the market might do, and I know where it might do it, like here or here. And I'm going to look at the behavior here. And then either it's going to pop, keep going, which might happen because we're in an uptrend, or if I exhaust, all I did was squeeze the shorts and now I got the longs. And if I come back the other way, I have fuel now to take me out the bottom. And I don't know which, so let's get over it. Nobody knows. So I think at the moment, when I say I think, because of the levels, 81% probability, this is what's on the hit parade for me. So I'm just waiting right here. So right here, I have liquidity in the book. Okay, so that's one piece. The other piece is I get VPOC migration, says what's below is too low. Let me get this in here. I got to put these back in. Hold on. I'm following a process. I'm not saying it's a great process, but I found that if I don't pay attention, I'm not going to be, I'm going to be missing out. So what else? This is the lowest location right here of a fair price. And then you notice how this volume point of control started moving the other way. That is saying what's below is too low. So all of that is, that's wonderful. Why didn't you figure that out sooner, Tom? Because that was resistance. When I break high to the mid and the VWAP, there's a possibility. What? I'm going to come back here and fall out, or I'm going to come back here and it's support. Notice where we come. It's now support. Who knew? It's on sale. And now the sellers go up. You can't throw any more in the cart, Tom. So now, where do I go? I squeeze and I come across, and my stops are up at the opening swing, which was there. That's what I know. So now, going up, going to the moon, clueless. Now what? So my new retail price is here. Too low, going higher. Pull back, too low, going higher. Move higher, going higher. One moment. Sellers are here. Now, buy stops, opening swing high, right? Then what's happening here? Liquidity. And now, as I'm coming up, 4, 1, where's the buyers? Where's my market orders? What is this delta I'm seeing here? All these buyers. So I've got aggressive buyers, and I have this passive liquidity sitting in the book. And so the passive, you don't see the passive side. If we have icebergs, we can see them, but we just can't see the limit order book. But there has to be a passive seller when you have an aggressor. So we have aggressors here. You can see the delta. And why aren't we going anywhere? You're asking. Because there's a passive seller. When you see the aggressors, what does it tell us? We can see this in Bookmap. we don't know what will happen. But when something doesn't happen, when you see an aggressive buyer, and aggressive buyers or market orders, whether they're stops or initiators, and it doesn't go up, that's absorption. They're being absorbed. Think Pac-Man. So right here, we break low. Right here, there's trouble. And notice where we are. Back at that variable high volume node, which was too high. And there's no way to know until here. Once I break here, now I have support. And in the microstructure, right here, I have resistance. No clue, by the way. No clue. Let me show you something else. So I'm the clueless, but I'm not ignorant. It's only maybe. Maybe, maybe, maybe. What do I know here? Buyers are here. Sellers are here. Now, I don't know until this that the sellers are below the buyers. That's a trigger. Now, where's the high volume in here? It's right here. What is this, Tom? Isn't this the same as that? But this is a shorter time frame. This is called mean reversion. This is the mean. The mean is where the high volume is, and it's that little thing sticking out right there. So if I get a trigger here, and I don't get, and the reason I know I got a trigger is, see the sellers? Where did my buyers go? They were absorbed, and now my sellers have taken control. Now, the other part of this is, what often happens is we're going to come back and test. So if the buyers were here, the sellers are here, this is the trigger. I'm below the buyers. This is what makes a trigger. My high volume in this auction or consolidation was right there. There. See it? So this is chop, 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 chop. That's a consolidation or an auction. If I break below this, then we found the shopping experience too high. Sorry. And where is that too high? Right there. This is called mean reversion in a microstructure. It's a trigger. You could be selling this if it's in your plan there with a stop above that. And then you're trying to come back here. Or here. Because you might get buyers here, which you do. So what I like to do is if I get in a position, I want to try to scale in front of where I anticipate retail trader behavior, because they could buy this and it could come out the top, right? So the scale has to be here or here, and then you're looking for it to fill the gap because there's a probability. Now let's look again. New retail price, right? Too high. You have to clear this. You break here. This is now resistance. That's resistance in a developing daily time frame. This is resistance in the microstructure. So it's all the same. Too high. What about this one? Support. Break below it. Too high. This shifts down. That's too high. Break low. Too high. Watch. Break. This makes your teeth chatter because this might be too low, but we know what? That's too high. Break low. Now we have resistance here. Why? See how they kind of move around? Now we get a big sweep here. And where are we? Inside of yesterday's range, next target, and there's resting liquidity. So what you have here only is short. This, if you didn't get this, when you see this, your antenna goes up. When you get that, you could sell it there. You're more aggressive. You sell it there, and your teeth chatter more. And you scale there. When this shifts down, resistance is there. You can sell it there. You can sell it there. All up to you. These are all structures that you can operate with to fill the gap. Then, I had no longs today, though my teeth chattered many times. Let's go look a little further, and then I'll come up and look at your questions. I'm just trying to kind of move along here. And this is in the first, half hour. Sweep, Now, this gets a little more auction or profile oriented. Let me show you. VWAP mid, resting liquidity comes in, and this was previously turned out to be support. It becomes resistance. This is an outside edge of a distribution called a low volume node. And what else is here? Remember this? So we get into yesterday's range. Our context sheet says, keep going, young man, keep going. When we come outside, there's always concern. And what was this? The naked volume point of control. What is this? This is yesterday's fair price. What am I doing? I'm going from developing fair prices, looking for unfair prices, going back to fair prices to test right there. There. So fill the gap. Next place here. Target. Look where it is. It's not a coincidence. Traders are shoppers. Are you guys still with me? Where can you find the PDFs? There's a link in the bottom of YouTube, but I can tell you the PDFs by themselves are just like, you might as well hit yourself with a hammer. There's no plug and play. You need to really come to Trader Lab and soak it in. There's a library of webinars. This really is learning to speak a language. This is the language of the market. I don't use any indicators. I found the problem was the indicators. They weren't the solution. I'm not saying you can't figure out how to integrate them, but if you don't understand market mechanics and levels and what the market is about, and the market is not your indicators, you're not going to change your outcome. So for traders who are serious, it's really about roll your sleeves up and retool yourself to what the business really is, at least the way I've defined it. I'm not saying it's the only way to trade, but I'm going to say is if you're doing what most other retail traders do, you shouldn't expect a different outcome. And you know the failure rate is pretty extensive. So let's look at what this says. This was an open or a naked volume point of control. We tested it coming down, we break, we test it coming back up. If it's too high, then we have yesterday's, which is down here, which we tested here. So think of this like support and think of this like resistance. This is an outside edge. Okay, so this is the mid and the VWAP. What do we anticipate here? Stops and retail sellers. What else do we know about it? Mechanical retail traders take this trade and often will get a counter rotation and then they get squeezed out. So this is a very high risk trade, but it has location and an outside edge. Let's see what it does. There's your squeeze. This is the trap, and this is the actual short. Do you see how this might work? This is retail traders. This is mechanical traders. Sell the mid, sell the VWAP. In Trader Lab, you would know, and it doesn't mean they don't get paid. Remember, the gamblers always get paid. But I know now there's a bazillion buy stops up here. Wouldn't you suspect that? And would you want to participate with average retail traders? I don't. And if I miss this, I'm okay, because there's always another bus coming. This is the short. Look at the liquidity. Look at the icebergs. And the buy stops are here. Once, and this is the retail sellers. I call them the gamblers. And again, gamblers get paid. This is them. So they get, here's the selling, there's the rotation. Now, and this is where FOMO hits you. Oh, it's going to go down, and you sell this. You can't stand it anymore. Meanwhile, the buy stops are here. There's the buy stops. You can see them coming out right there. Buy stops, icebergs, liquidity. Now we want our trigger. This is a short. Now, whatever happens, happens. You know, it's like what happens in Vegas stays in Vegas. VPOC migration. This is where the short is. You could either sell it here or you could be selling it here. Your stop needs to be above this. Be there, could be there, could even be here. It's up to you and your plan. VPOC migration. critical element. This is too high, and this needs to come below here. If it comes across, it's going to squeeze. That's it. That's the short. You would learn this in Trader Lab. Now, the thing about learning something, it's learning how to think. It's not just push the button because the mid and the VWAP shows up. It's about don't push the button because of what think like a retail trader, don't act like one. This is your short right here. So if you don't, now the thing is, you don't want to sell it here. What you want to be doing, and again, this is not a recommendation, is where did the sellers take control? Wasn't it right there where the sellers took over? Let's look at it in micro. Now, you could say the same thing here. The sellers took over here, but we know the stops are there. So if you're going to sell this thing, you can't put your stop there, in my opinion. You got to be away from the noise. When it takes the stops, now where's our buyers? There, there, here, okay? Break low. Your trigger now is here. I'm going to put a little box around this so you can see the structure. Where did it break? Where did the sellers take control? It was right here. Where's my high volume? It's right here. What is my high volume? Where most of the volume is. So if I break here or here, I can sell it there, 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 I can sell it wherever, and my stop needs to be above here or out there. Up to you. All these are shorts in the Trader Lab if that's your thing. Now, where are we trying to go? Ahead of here. Why? It was too low. There's a sweep. Uh-oh. Counter rotation, Tom, right? See? Now what? Teeth chatter, support, and I got to get under here. Now, I have over 90% probability to get the ETH low. Let me ask you a question. Would you hold through counter rotations to get to this high probability target? Me? Yes. You? Up to you. Watch. Target. So shorts only, you know. So now, let's keep going. ETH low, target. Now we have another target, you're saying. Remember from the top of the stream. Let's see if we can find it. So, and this is today, okay? So we missed the ETH high, remember, overnight volume point of control. That was a target, 81%. Missed it. So sorry. Then coming down, we have 58-ish, which is the top of this consolidation. Too high, too low, retail. And if this is too low, because it's an auction, then that could be it. And it can get under here. And the next target, if I get under there, was here around 52. But we're looking around 55 as our target on this thing. And it could go to 52. And here, IB high. So this was the next target. So it was there, there. So for me, this is kind of where I went with this thing on the shorts. So, and the structure's laid out in the profile. So let's watch. So come out. Who knows? We have that single, which I don't think is on here. 58. We have the high volume node, which is around, what, 54, I think. And then that IB, which was 52, something like that. So VPOC migration, I'm not paying that. Sweep suggests down. Sweep suggests lower. Sweep, which means absorption, and they're sweeping the book, lower. VPOC migration, I'm not paying that. VPOC migration, too high, too high. VPOC migration, I'm not paying that. Press, look at this guy, skews the book. Sweep, and this suggests counter rotation. So this is where, on my trade, just before I started streaming, this is where I got out. This thing right here, right there. Whoops. That was it for me. No, I haven't seen any of this. Oh, look where we come. I'm not paying that. Liquidity. I'm not paying that. Break low. This is another short. I haven't seen this. So this is with the benefit of, but it's the same structures. You can see it, right? So all I'm doing is I'm reading the auction, and I'm going to get run over with you too. So don't worry about it. If you don't want to take a stop, it's the wrong business. You do have overhead and cost of production. So too low, shifts up. That's what is creating this. And what do I have? VWAP, mid, and this. And I have this variable high volume node. Look where it is. I'm going to throw a line on here just to highlight it so you could see. So when the market's coming up, I know that this is the retail price at the time, and this is too high. When I come up, I'm going to be looking out here. Now, because the VWAP and the mid is here, I'm extremely uncomfortable. I didn't take this trade. I might have a problem with it, but here's where I would take it. The fact the mid and the VWAP is here, as you know, I will not sell this because of the stops. I get VPOC migration going up. What does it do? Too high. I can sell this. My stop has to be out here. I am not going to put it there. I'm allergic to that. This is a short, and my resistance really is here, but I can't put my stop here because it can come up and come back like you saw before. And that's a short, which I did not participate in. Watch the behavior. Now, what's too high? I haven't seen this, so I'm just going to throw these on here so you can see them. VWAP. So we have too high. We have too high. Okay? Outside. See how it's behaving? I can put these on here, and then I have to try to get in alignment. Now, we got to a target down here. So for me, I'm very okay just being in the Barca Lounger. And so you know where this target came from. I'm going to show it to you one more time, then I'm going to look at your questions. And thanks for your patience. Here. Targets were there and there. And then this was also something, but we had this. So going down, if we got through that, we get through this. If we get through this, we get to that. And then, whatever it does, it does. So roughly 52-ish. And then this one around 55, 54. Okay, so let's go back and see where we are. So it was 52, 52-ish. 52, target. $52. So that's your target. And if it gets inside, there's more. If not, you could be done and you're hanging out. And then you're either done or you're going to operate in shorter time frame and trade rotations. Anyway, I hope you're getting something out of this. This is trading the auction, and this is really how the market works. Now, our job is to try to define the condition of the market, work with auction-based behavior, which is created by the participants, not our indicators. And then if it changes and we hit a key location, done. Now, we can come across the range here. Remember, the higher time frame is up. Anyway, these aren't trade recommendations, but we might have hit the low of the day, and now we can come across the range and squeeze out the shorts. Possible, right? So we'll see. Not a recommendation. Your questions, please, and thanks for your patience. Joe, it is a TPO chart. The chart I'm showing is a combination TPO and volume profile. Volume profile is the most important thing. TPOs have kind of been retired. I don't use TPOs. I only use them for singles, which are those black lines, and that's just like an internal 30-minute gap. They have some significance because the market didn't trade there really for very long, so the market has a tendency to come back. It's no different than low volume nodes. These areas out here where the market moves quickly, the market might at some point come back to them. And if you look down here, what you have is outside edge, high volume right there. And if we break away from it, then it's too low. Same language. And then as I go up in time frame, the market, when it consolidates, too high, too low. And if this retail price or high volume is too low, I leave it and I start this process walking up the food chain. This is potentially a long. And the idea is now the market is short. The market goes up to go down, goes down to go up. And where's our resistance? Well, we got some up here, we got some here. But if the market is short, we got our buyers in this leg. And then if we get above this one, then we've got the rest of the crowd, and we can squeeze and come completely across the range. It's not a recommendation. We might just, I don't know what it'll do. But I tend, and I'm not saying this is, I have no opinion on it. I tend to try to trade with the dominant side until it changes. If now the buyers are back in control, and I don't have a trade for it, then I don't take the long. I just wait for my trade. And if I don't get another trade that fits my plan, I'm already had a terrific day. So it doesn't matter. It's just really about alignment, waiting for your trades. Because who knows where the bottom is, like the low of the day. I have targets. I had a target here. So when I'm putting the trade out, I have my exits lined up here, and I have no idea, if it'll get there. And I manage my trades, trailing stops. I mean, the next place for it to go was here. So if I got below this level, then that was the next target. So initially, I was looking out here for targeting, but I knew it had to get through certain levels to get here. So I just put the trades out, the range, and I look at the probabilities in the sense of my statistics and just my understanding of how the market works, and then it's still random. Now this, you see the buying, chances are, and it's not a recommendation, we're going to come out to high here and squeeze. And then we'll see, I hope that makes sense. Guys, if you find this interesting, there's no holy grail. There's no secret sauce. There isn't. This is a foreign language. So have you ever tried to play a musical instrument or learn a foreign language? And most of us with our indicators, and I'm not against them. What I'm against is going down these rabbit holes where you put yourself out of business. I think you can avoid that if you come to Trader Lab and do the work. But it's going to mean that you're going to have to let go of that security blanket. Anybody, when you were a little kid, did you have like a little pet? Like I had a little wind-up bunny. It would play lullaby until I decided I wanted to be a doctor, and I opened the thing up. That was the end of that. And I didn't become a doctor, though I did go. I was in pre-med. Or the blanket, security blanket, our indicators are our security. Right? Because we are following a canned, mathematically based derivative of price. And because it's random, they have winners, just like all the patterns. How many times do you see a pattern and you go, oh, it's going to go down, and you sell this? Or here, it's got to go lower. You know what I mean? And you're doing this all day, and you're taking stop, because your mind sees things. But if they don't have an edge, you're on your way out. Same thing with indicators. You see patterns. They work randomly. That's fine. We try to make them better. But over time, if they don't have an edge, you go out of business. That's what most retail traders do. They get a software toolbox. They think right time frame, right mix of indicators. More indicators, more certainty, more risk avoidance. Very logical. Unfortunately, you're fulfilling a psychological need. You're not operating in the business. You're operating based on your primal wiring, and you're making decisions that you're not even conscious of that are based on the behaviors that have worked for you in your life outside of trading. When you come to trading, it's like you might as well be on Mars. Whole different set of rules, but we're wired for the rules that work in the outside world. When you try to push back again, like I'm not going to jump in, I'm going to wait, and then you do it anyway. What is that? It's the primal wiring. It's the chemicals, the hormones that are released in your brain. I never understood this early on. Nobody talked about it. When I started trading, there were no really off-floor traders. I didn't know any. And all my buddies were floor traders. They thought I was crazy, and I thought they were crazy. Turns out they were all crazy. Because they were in a different business than I was trying to be in. And early on when technical indicators were developing, and I like to say this, I shared an office with George Lane. He created stochastics. He had an Apple I. I went high tech. I got an Apple IIe. So that's how I started with math and simple formulas, and stochastics, as you know, is a really hybrid moving average. All oscillators are moving averages. So, derivative. So, but when I saw stochastics, I thought it was the holy grail. So, because the line crossed over and the darn market went up, Well, every time it does this, look at that. Of course, you don't really look at all the times where it just ripples along and you're getting chopped into oblivion because your mind doesn't remember that. So then you go, well, this works sometimes pretty good. Maybe I can make it better. Is that you? That's all of us. But we're looking for something else to give us a red light, green light. I don't want to make a decision here. Let my indicators do the work. I'll just, when it says do this, do that. When I built systems, I was taking that idea further. It would say buy, sell, they put a price up there, put the stop here, and off you go. And it had, and it would work, except over time, it would leak equity. So then it was a regular optimization schedule. I'm just saying this because when you go in with your screwdriver at the end of the week, you're doing the same thing I did, but I did it with systems, And I had, and this is when PCs first came available. A 286 was the CPU. I'm just telling you, I think if it had, I don't even remember how much RAM it had, not enough to light a light bulb. So, but that's where I started. And all I'm saying is I kept waking up in the same place because I was doing derivatives of the same process. That's not aligned with the business. You guys, most of you are probably doing the same thing in some form. So if that's your result, then you really need to step back, and I suggest you do it and think about it. Is this the do you have a viable solution, or you just keep waking up in the same place in spite of the random winning trades? And I have to say this to you because we all do that. It's the winners that keep us coming back. It's the same reason the gamblers keep coming back to the table. They have winning hands, but they don't have an edge. So the house, even though they pay the gamblers, nets. So our goal as traders is let's be the house. Let's try to set it on the house side of the table. And no, it's not going to be easy. And it doesn't mean you'll be able to do it because the psychology in this business is the problem. It really is. Being able to do it. Even if you know what you need to do, you're going to be stimulated chemically by what you see. Like right here, gee, I could have sold that, right? Well, maybe. Is this a short? Well, it isn't for me. Might it come back here? Yeah, it might. Can I sell it? I can't. Now, when you're sitting here looking at these rotations, how many of these would you have sold? Would you, by the time you get short here, what happens? Hopefully, you scratch it. What happens if you sell it here? You take a stop. What happens if you sell it here? Take a stop, maybe? Is that what you're doing? You're on your way out. Because the rotations are micro. We can't operate in this. Scalpers, as far as I know, are just a fast way to pay your broker and get out of business. The Dollars are made. You've heard of risk reward ratio. Dollars are made in this business by catching the larger rotations. The smaller things are triggers, you know? So like this is a little trigger. Am I going to sell it? No. Is it the high of this the move and we're going to come back here? Maybe. Right? Where did I come? There. Not quite, but that's a location. Am I going to sell it? No. Might it go down from here and make a new low? Yeah. Why can't I? And this isn't a trade recommendation. If your plan says sell it, knock yourself out. This is resistance. It's a variable high volume node right there. Should I be trading that back to that? Maybe. Maybe. I don't call trades because you don't want to take my stop. Let me show you this. What do we know about this price? Let's just take this as shoppers. Oh, sorry. Let me try this again. Let's be shoppers again together. We're in the store. Try to do this. Micro trigger right here, right there. Now I'm going to tell you, I have no interest in doing anything. I'm hanging out. But let's look at structure together. Sellers are here. Too high is there. Trigger, resistance. Now, two things can happen, right? Now, I have no trade. I'm just hanging out with you. It can come here, here, here. Or we're just going to do a little wiggle and we're going to squeeze them out. Which one do you think it is? And is this a trade you would take? Is this a short you would take? Just think about it. Is this a trade that would fit your plan? If you get through there, then you got this. You get through this, you got that. So how do you handle that? Think about it. But is there a logic to this? Now, it doesn't mean it's your trade. I'm just saying is, what makes this different than this? Or any of these? See? Now, this is not, I'm not saying this is a trade. I'm just saying is, it's something, right? Do you guys follow? Can you kind of see this? Now, I'm not saying anything more about this than we can, if we understand the market and where it might behave and what is important in here. And this is not easy. This kind of thing, I'm going to say, this is not what most traders should do. I'm not saying I would do it, you know. But if you understand how it works, there's your entry. See, it's not this. This is FOMO. This is the test. If I was to sell one tick ahead of this, because this is where my sellers took control, and right here, I can sell here. High volume is there. That's like, this is reversion trading. And the next higher time frame is here. This is reversion. This is called mean reversion. The joke is, yeah, it's mean because we're trying to come outside. So the idea is if you sold this, this is the reversion there, and coming back, the reversion in the next higher time frame is there. The short would be, if this is your trade, and I'm not saying it's anybody's trade, is to go there. That's called mean reversion. Are you guys with me? What is the PPT? Guys, if you're interested in this, and if you're visiting in YouTube, thanks for stopping by. There's a link in the bottom of YouTube if you're interested in the Bookmap Discord Trader Lab community. There's no cost for this. You know, I'm not a vendor. It's not a course. it is a community. And the thing about it is the Trader Lab's a community of traders that come together to leverage their experience. It's not about me, it's really about you. It takes a community to do this work. Data mining, research, we're constantly looking to all improve and support each other. You will find that if you do the work, and you have to develop patience to wait for a trade that you've vetted. That means you can sit here all day and either never get a trade or get a bunch of them. The key thing to learn is what I'm showing you right here. It's called mean reversion. The mean is here, the trigger is here, test is here. That's the high volume. This is your little store down the street. I'm not paying that. In the next time frame up, the developing daily time frame, this yellow line is the retail price. Think of it like your supermarket. So I go to the little store, sellers are there, buyers are here. They go, I'm not paying that. They leave the store. Then the possibility is to come back here. Doesn't have to, but that's the possibility. It's called mean reversion. This is reversion. Coming here is reversion. If it doesn't, say Laguerre, that's what trailing stops are for. You would be risk neutral. And the idea is minimum two-lot configuration, so you can manage the lunatic, you, me. When you get risk neutral, it calms you down. It's a psychological thing, because then you know the worst that can happen is you scratch the trade. If you're running all in, all out, you're going to go from euphoria to depression. What should I do? What should I do? Fear. And then you're going to punch out of the trade. Well, the trade hasn't failed. Doesn't the trade need to fail? And it doesn't matter because statistically, this is the probability that we're going to get there. It doesn't mean we will. Remember, randomness. If I'm in this trade and I'm risk neutral, I'm going to be rooting for the home team to go here because this is the primary target. It's reversion. What you see happening here is the same reason it might go there. And I say might because I don't know. So then you just sit in here with your runner, and I talk only a minimum two-lot configuration, not that you should trade a two-lot, but you need to vet and learn statistics so you can develop the confidence to manage your emotional state. When you don't have something tangible like a statistic, all you have is dopamine, fear, cortisol running in your brain. So it's like being under the influence. I'm sure you wouldn't drive drunk, I hope. Well, when you have the chemicals, it's like trading drunk. You're under the influence and you're not conscious. Your willpower doesn't supersede these chemicals. That's why if you step out in front of a bus, hopefully you don't, you're not going to be thinking about it as far as, gee, what should I do? There's this primal wiring in there and you're going to react. That's kind of what's going on here. So when you're sitting over here and you're looking at this, what you're seeing now is fear. What's it going to do? How about this? You don't know. If I don't know what it's going to do right here and you don't know, what do we feel? Uncertainty. Remember the word I'm saying, feel. You feel uncertainty, then you're going to wait. What are you waiting for? Confirmation and certainty. Why? You're wired not to take risk. Is there a saber-toothed tiger behind the rock? Well, let's make sure there isn't. All right. Oh, look at that. There's a piece of dinner running away. Where is it? It's running away from me. I sell here because now it's FOMO. Well, now what? You see? By the way, the sweep suggests a counter rotation. Now, the thing with the trade is, where does it fail? It's all the way back here. Are you able to hang out and give this back without, going behind the garage and stepping on a rake? Or are you just going to go, it's one of thousands of trades in a career. The outcome is random, and the structure of the trade suggests here. Let's see what it does. I've only got 5 minutes left. You guys can track this. And this is all you got to think about. Mean reversion. Subject to your plan, you could just trade here and be done with the trade. I think there's enough range to make it worthwhile. You'd be risk neutral, so your stop would be here. So the worst that happens is either you scratch or you have a trailing stop and you get taken out and you get a few burgers and you take the family out. Well, considering inflation, just for a Happy Meal. How are you guys doing? We doing okay? Please give a like if you're visiting in YouTube. Um, for Investor RT, you would want the Pro version. If you go, there's a forum set up in at linsoft.com, Investor RT, and you can see there's charts you can import, so you have similar settings that I have. If you're using Bookmap, you can set this up so it actually IRT exports these levels automatically, which is very convenient. It updates. So some of these are manual. I do these manual because these are higher time frame levels. And then these over here are also something I do as the day develops. So this needs to go there. If it can't get there, it's going to come back across the range and squeeze me out. I have to be okay with that. This sweep suggests the counter rotation. That what we don't know, and part of the thrill of trading, is how far. So if it comes out, then that trade would be over. But it's still okay for me, other than how I feel about it. You notice the words, how do you feel? Well, do you think the dealer in the casino gets depressed if a gambler gets paid? They just deal in the next hand. We have to accept that we're in a random distribution of outcomes. I know the design of the trade is to go there, but if this is too low, it doesn't have to get there. It can just now come back and squeeze out the shorts in here. You see? It's always one or the other. So, and this is just one trade. So that's TraderLab, guys. And I'm not saying, it's the answer, but I think it's something probably very different than what you've experienced. And there is no holy grail, no secret sauce, no easy. If there was, we'd all have ATMs in the basement. This is going to require a lot of work. And the work is changing what you believe the business is and managing your emotional state. So this trade looks like it's going, as we say, south of the border. You would scratch it, depending where you have your stop. This is where our resistance is, and there's buy stops here. And that's fine. That would just be it. Okay? Please give a like if you're visiting in YouTube. Be sure to watch yesterday's stream. Yesterday's stream, I got in some really micro structures and for the longs, and you can see how these things resolve. I thought it was pretty good. And if I like them, maybe you'll like them. Don't forget to give a like. Use the link in the bottom of YouTube if you're interested in TraderLab. There's no cost for it. You won't be solicited, but I have to assure you that it's a professional environment. It's not romper room. It's not like many of these chats that you come across in your journey. We're really all here about sustainability and building career path. If that's of interest, use that link in the bottom of YouTube. Give a like on the way out. And I look forward to seeing you guys tomorrow. Trade well, trade safe, and thanks again for visiting the TraderLab today.
20 seconds. 10, 9, 8, 7, 6,